Okay, so you want to own a data center. You buy a massive warehouse, fill it with server racks, sign a lease with Amazon or Microsoft, and watch the rent checks roll in every month. You own the physical real estate of the internet. Every time someone streams a movie, sends an email, or trains an artificial intelligence model, they pay you rent. Sounds simple. It is not simple. A data center looks like a real estate investment. From the inside, it is something else entirely. It is a fragile, terrifyingly expensive thermodynamic engine running at maximum capacity 24 hours a day. The story of how data centers actually make money is not a story about land or buildings. It is a story about electricity, heat, and the constant threat of catastrophic failure. Before you make a single dollar, you need to survive building the thing. You cannot simply buy a cheap piece of land in the middle of nowhere and put up a metal box. The location is dictated by two things: fiber optic backbones and power grids. You need land sitting directly on top of massive internet trunks. You also need a power grid capable of delivering industrial levels of electricity without blinking. Land with both of those attributes is rare, and it is priced accordingly. In places like Northern Virginia, the data center capital of the world, a single acre of dirt can cost over $3 million. And you need dozens of acres, and then you build the facility. And this is where the real estate illusion dies completely. A traditional commercial office building costs maybe $200 a square foot to build. A modern data center costs between $1,000 and $3,000 a square foot. And the building itself is the cheapest part of the project. You are not building a warehouse. You are building a fortress designed to keep computers from melting. To do that, you spend money on a scale that makes traditional property developers physically sick. The industry does not even measure data centers in square feet. It measures them in megawatts. Building a modern data center costs roughly $8 to $12 million per megawatt of capacity. If you want to build a 50 megawatt facility, a mid-sized project by today's standards, you will spend $500 million before a single customer moves in. Where does $500 million go? Look at the perimeter. You need backup power, and not a small generator. You need a fleet of diesel generators the size of locomotives sitting outside ready to spin up in less than 10 seconds. You need massive arrays of lithium-ion batteries called uninterrupted power supplies. These batteries hold the entire electrical load of the building for the brief window between the grid failing and the diesel generators catching the load. If those batteries fail, the servers crash. Then you need cooling. Computers turn electricity into math and heat, mostly heat. A 50 megawatt data center generates the same amount of heat as tens of thousands of space heaters running at full blast inside a closed box. To stop the servers from catching fire, you need industrial chillers, massive cooling towers, and miles of reinforced piping pushing chilled water through the facility. Add it all up, you just spent $500 million. You have a building. You have no customers. Now you need to sell the space. And here's the first thing nobody tells you when you picture owning a data center. You do not sell square footage. You sell uptime. The people renting space in your building are large enterprises, cloud providers, and artificial intelligence companies. They demand service-level agreements. An SLA is a contract guaranteeing a specific level of reliability. The industry standard is 5 nines. That means 99.999% uptime. Let that number land for a moment. 5 nines means your facility is legally allowed to go offline for exactly 5 minutes and 15 seconds per year. If a transformer blows, if a cooling tower fails, if a backhoe cuts a fiber line, the clock starts. If you stay dark for 6 minutes, you breach the contract. When you breach an SLA, you do not just apologize. You pay financial penalties. If an outage takes down a major financial trading platform, the penalties written into the contract can wipe out your profit for the entire quarter. The customers do not care if the local power grid failed. Your job was to build a system that ignores the grid. You failed? You pay? So your building is open, the tenants move in, the servers turn on. Here is where the operating economics take over. The single largest line item in your monthly budget is electricity. A large data center uses the same amount of power as a small city. We are talking hundreds of thousands of dollars a month just to keep the lights on and the servers humming. In most wholesale leases, the tenant pays for the actual power their servers consume. but the landlord pays for the overhead. You pay the energy cost to run the chillers, the fans, the security systems, and the lighting. This overhead is tracked by a metric called power usage effectiveness. If your cooling system is old or inefficient, your overhead costs spike. The tenant does not absorb that inefficiency. You do. It comes straight out of your margin. Then there's water. Evaporative cooling systems consume staggering amounts of water to reject heat from the building. A mid-sized facility can easily consume 300,000 gallons of water a day. In regions facing drought, local municipalities charge massive premiums for commercial water usage. Sometimes they simply deny the permits entirely. Here is the trap nobody sees coming until they own the place. A data center has an expiration date. An apartment building built in 1990 is still perfectly usable today. A data center built a decade ago is often functionally obsolete. The obsolescence happens because the tenants change their hardware. 5 years ago, a typical server rack drew maybe 10 kilowatts of power. Then artificial intelligence arrived. Today, companies deploy massive clusters of graphics processing units. A single AI rack can draw 50 to 100 kilowatts of power. Your building was designed for 10 kilowatts a rack. The floor cannot support the physical weight of the new AI servers. The air conditioning system cannot remove the concentrated heat. The electrical whips cannot deliver enough power to that specific footprint. The tenant comes to you. They want to upgrade their hardware. They tell you they need direct-to-chip liquid cooling. If your building cannot support it, they will not renew the lease. They will move down the street to a newly built facility. To keep the tenant, you have to retrofit the building. You tear out the old air handlers. You reinforce the raised floors. You install complex liquid cooling manifolds. A retrofit of a live operational data center is terrifying. You are doing heavy industrial construction inches away from servers handling billions of dollars in global transactions. One dropped wrench, one severed power cable, and you trigger the SLA penalties. And the retrofit costs tens of millions of dollars. You're spending a fortune just to keep the rent you already have. You do not gain new square footage. You simply buy the right to stay in business for another 5 years. To understand how this plays out in the real world, you need to look at what happens when the thermodynamic engine actually fails. Look at the major outages that hit the industry every few years. A heat wave strikes a major city. The temperature outside hits 104 degrees. The data center was designed for a maximum outdoor temperature of 95 degrees. The cooling towers on the roof cannot reject heat fast enough. The chilled water loop starts warming up. Inside the data center hall, the temperature climbs. 80 degrees, 90 degrees. At 100 degrees, the servers begin to protect themselves. They automatically shut down to prevent their silicon chips from physically melting. Whole sections of the internet go dark. The operator panics. They bring in industrial fire hoses to spray water directly onto the cooling towers to force evaporation. They fail. The SLA penalties trigger. The customers demand millions in credits. The next time leases come up for renewal, the customers demand lower rates to compensate for the perceived risk. The value of the asset plummets. A single hot afternoon destroys years of equity. So why do the smartest institutional investors on the planet keep pouring billions of dollars into this exact asset class? Private equity firms and massive real estate investment trusts dominate the market. They do not care about the servers. They care about the yield. The smart money understands that while the operating risks are brutal, the underlying financial mechanics are incredibly efficient. When you sign a hyperscale tenant like a major cloud provider, they sign a 10 to 15-year lease. That is guaranteed, contracted revenue from a company with $1 trillion market capitalization. A bank will look at that lease and lend against it at extremely favorable rates. You borrow cheap money, build the facility, collect the rent, and pocket the spread. It behaves like a highly reliable fixed income bond backed by the physical infrastructure of the digital economy. There is also a massive tax advantage. A data center is classified as real estate, but a huge portion of the construction cost goes into mechanical and electrical equipment. Generators, chillers, and batteries depreciate much faster on tax schedules than the concrete shell of a building. Owners use accelerated depreciation rules to wipe out their taxable income for years. They collect massive cash flow and pay almost nothing in corporate taxes. Let us build a realistic scenario. You construct a 20 megawatt data center. You spend $200 million all in. You lease the entire capacity to a single cloud provider. They pay you roughly $120 per kilowatt per month. That translates to about $28.8 million a year in gross revenue. Now subtract the costs. The tenant pays for their own server power, but you pay the facility maintenance, the specialized engineering staff, the insurance, the security, and the equipment reserves. Your operating margin sits around 60%. Your net operating income is roughly $17.2 million a year. Against a $200 million investment, you're generating an 8.6% yield. That is a very strong return in the commercial real estate world. And the tenant is locked in for a decade. The land quietly appreciates. The asset generates steady cash. This is the optimistic scenario. Now look at the bad year. Your 10-year lease expires. The tenant looks at your facility. It is a decade old. It cannot support the massive power demands of their new AI clusters. They tell you they are leaving unless you upgrade the power density and install liquid cooling. The retrofit will cost $40 million. You have to take on new debt to fund the construction. At the same time, local power rates spike. Your operating margin drops to 40%. You spend the $40 million. You keep the tenant. But your yield crashes. You're carrying more debt, generating less margin, and the asset is functionally obsolete again in another 5 years. The difference between the people who build wealth in this space and the people who get wiped out is capital depth. You need pockets deep enough to constantly refresh the massive mechanical systems holding the building together. If you cannot afford the retrofit, your building goes from a premium tech asset to a very expensive, empty concrete bunker in a matter of months. The cloud sounds light. It sounds invisible. From the inside, it is heavy. It is hot. It is a loud, terrifying, incredibly expensive industrial facility running on the razor edge of physics. You are not buying real estate. You are buying the privilege of fighting thermodynamics every single day. The rent checks arrive only as long as you win that fight. The moment you lose, the whole system melts down.